Okay, in 526, it gives us another bank reconciliation. And true to form here, you'll notice that deposits in transit are added and outstanding checks are subtracted from the bank side. And then we've added some interest earned of 88. We have a bank service charge of 110, which is subtracted. Take note that our error is an addition instead of a subtraction instead of an addition to our book side. And then, guys, every time you see an NSF check, remember that's a check that you deposited that didn't really get deposited. So it has to be taken away from our book side whenever a check does not clear the bank that we have deposited. So NSF checks are always subtracted from the book side. And so just, if you memorize the fact that deposits and transfer are always added, and then outstanding checks subtracted from the bank, and then service charges and NSF checks are always subtracted, and then interest earned is always added. See, the only thing that you're really looking at that's an unknown here is the check recording error. Okay, so in this particular case, we had a return with the bank statement. Let's see, review of the checks that was returned with the bank statement. It was noted the amount of check 681 was 680, but that in the company records was 68. So we've left a zero off. So we simply have to, that actually got cleared the bank. So um, we have to adjust for what we did not decrease our cash account for, which was 612. The difference between the 680 and the 68. Okay. So looking at all these guys, remember that authors in accounting love to back into things. If you know how to back into something, that means you really know it. So they've given us a reconciled amount, 36.4, and then they ask us to back into the bank balance that we initially had and to back into the book balance that we initially had. So in this case, we take this 36.4 and we would add these outstanding checks, and we would subtract then the deposits in transit, and we get a bank balance of 27,950. And we came over here and we took this 36,400 and we added back the NSF check and the error and the bank service charge, and then subtracted out the 88 in interest. Then we would get 40,274 as our initial balance on our books. I want to remind you that you would want to do a journal entry. It's not a part of this problem. It's not all of the reconciliation problems have journal entries associated with them, but if it were you were asked on a test, which one of these would you adjust? And remember, you adjust the 88, the 110, the 612, and the 3240. You would have to make an adjusting entry associated with those. Remember, too, to read over carefully in the chapter who gives you an illustration of a bank reconciliation, and it keeps you um, on the cutting edge there with that, and just kind of describes it for you. And it's very straightforward, but it's just something that a lot of students just don't have that much exposure to, and you need to know this to kind of answer a pretty good many of the questions out of the test bank in chapter 5. They have some kind of reconciliation of the cash account sort of question. So you'll be looking at that. Now, I'm going to scroll down to problem number 530. Let's see if we can get to it here. And these T accounts are offline just a little bit, but I think we can get the general gist of this. The emphasis here is to understand how the accounts receivable sort of operates with the allowance for bad debt. Now, I want y'all to realize that allowance for bad debt is a contra account that rides with the accounts receivable, so they show up together on the balance sheet. Okay? And so the difference in the two is going to be your net realizable value. So whenever you have an accounting question in the test bank or the quizzes that starts to talk about net realizable value, remember that's accounts receivable minus your allowance account for bad receivables, which is bad debt. Okay, and in this problem, they're going to give you all these numbers that go into your accounts receivable. Look here, you've got a balance of 425, and then you have some sales on account, which is going to debit your accounts receivable. Then you're going to have some cash collections on those receivables. That'll be a credit to a receivable because that'll be decreasing a receivable. And then any accounts that you wrote off will be on the credit side of the T account for accounts receivable as well. So you can come up with a December 31, 2020 balance here by just adding the two debits and subtracting the two credits, and you get a total of $620,000. So that gives you then in your allowance account that same amount that are written off against your allowance account because you are using one, right? And you had a beginning balance for that account. And then they give us this bad debt expense amount, $41,000. So your balance in this account is going to be $29,000. Now they give you a little bit of a jump through loop here to come up with these amounts, so you'll understand the activity within those accounts during a year. And then they ask you to do a subset, if you will, a presentation of what it would look like if it actually showed up in a balance sheet. And you'll see here that you would list accounts receivable first, and then right underneath it would be less allowance for bad debt. So your net realizable value then as of December 31, 2020 is going to be $591,000. And so that is, of course, your accounts receivable subtracting your allowance for bad debt. So clearly this is an account that rides with the other account and is always with it and stays with it. And it makes sense that it would, since it's directly associated and directly giving value, if you will, to the amount of receivables you may have listed on your balance sheet.